Thank you for watching this video. Today we will be doing technical analysis on the stock market for the week ending Friday, August 20th, 2021. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the developer, president, and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals is a proprietary stock market trend direction and risk management model. The first chart that we're going to look at is a weekly candlestick chart of the S&P 500 that starts at the beginning of 2021. So we're really just focusing on calendar year 2021. In the upper right-hand corner, that is this week's candle. A lot of volatility this week, and the good news is we didn't finish near as negative as it looked like we might have a couple of days ago. We had a pretty nice little rally here on Friday the 20th that brought us back up. We were negative 59 basis points, 0.59% this week on the S&P 500. And the good news is, too, is the volume was a little bit lower than it has been. So for a distribution week, and this is something that I really pay attention to, and I encourage you to do the same, watch volume, because these low volume distribution weeks, right, where if you lose money, it's a distribution week. And when the volume is down, it tends not to matter as much. If we had a super high volume week like this week back here in March, that matters a lot more than a low volume distribution week. If we pulled back to that 40-week moving average, that would be an additional 9% drop over what we experienced this week. And that is assuming we're, looking at the 40-week moving average where it's at right now. So if the 40-week continues to climb, that drop actually could be a smaller percentage movement. The next chart that we're going to look at is for the Russell 2000 Small Cap Index here in the U.S., and it's an ETF called the IWM that tracks that Russell 2000 small cap. And this has actually really been one of the weaker areas of the U.S. stock market. So now we're going to take a look at some things. We looked at the S&P 500 on a relative basis. It's holding up really, really well. It's been one of the strongest areas in the equity markets, period, on a global basis. And now we're going to take a look at some things that aren't doing so well. The IWM, the Russell 2000 Small Cap ETF, look at how this thing has just traded sideways really since the beginning of February. And you can see we pulled back to the 40-week moving average, that green line right here, in July, and then we closed right at the 40-week moving average again this week. We were down 2.54% on the IWM this week on higher volume. So again, we just looked at lower volume on the S&P 500, but look at the distribution here. Not horrific, right? It's not like it was back here in March of 2020, but definitely higher volume this week than last week, and one of the higher volume distribution weeks that we've seen in the last couple of months. So the good news is, this sideways trading action and the stopping, just almost exactly on the 40-week moving average right there. Hopefully what this means is the IWM is building a sideways base, and these things can be very, very constructive where whatever the investment is, in this case the IWM, can then move forward off of that sideways base. Hopefully we won't continue to see a deterioration and this thing rolling over, but we will want to keep our eye on this. As long as we stay above this 40-week moving average, probably not a lot to worry about. But if we start to see, a few more weeks of selling here and the IWM starts to trade below its 40-week moving average, that's not going to be a good thing. The next chart that we're going to look at is a year-to-date weekly candlestick chart of the MDY. That's the ETF that tracks the S&P 400 mid-cap index. So we just looked at small caps. Now let's look at mid-caps here in the U.S. And we've seen this sideways trading also in the mid-caps, not for quite as long, right? In the small caps, that started back in February. In the mid-caps, that really started in April, about the second week in April here. You can see we got to this blue line, which I overlaid here just before I started recording, and we just have not made any progress in the MDY since the second week in April. We are still trading well above the 40-week moving average here, and the distribution this week, by the way, we were down 2.02% this week on the MDY, but it came on normal volume. So, again, not too much to worry about there. Hopefully this sideways trading action in both the mid caps and the small caps here in the U.S. is nothing more than a sideways base. We'll keep our fingers crossed, but as long as we're staying above the 40-week moving average on this, probably not, a huge reason to get overly concerned. But again, if we go back and just take a look at the difference here in how large caps, the S&P 500 has been acting all year versus small and mid caps, you can definitely tell that on a relative basis, just eyeballing these charts very quickly, that large caps, the S&P 500, has been performing much better than small and mid caps, especially over the last few months. The next chart that we're going to look at is for the EEM, and that is an ETF that tracks emerging markets. And this chart starts in 2020, gives us a little bit more time perspective. And over here on the right-hand side, this is this week's trading. We were down 4.31% this week on the EEM on above average volume. And you can see over the last month, we've had a couple of high volume distribution weeks on the EEM. And the EEM is now trading well below its 40-week moving average. That is not good. And the EEM is negative 3.78% year to date. So, just by taking a look at a couple of charts in the U.S. and then going over to the international markets, and we're not done yet, so stay with me. Got some more stuff to share with you. But you can see in the emerging markets that, especially over the last couple of months, it really has lost its momentum. And that momentum now is to the downside. So, this is probably an area that, if you have exposure, maybe you want to rethink that. Obviously, that's going to be up to you and how you want to allocate your capital. But, when we start to see this kind of weakness and trading underneath the 40-week moving average, it's very possible that more downside is ahead of us. The next chart that we're going to look at is for the FXI. This is an ETF that tracks China large caps. And this particular chart I started in 2018 just to give us a little bit more data, a little bit more time perspective. And you can see this week alone we were down 6.48% on the FXI on pretty high volume. And over the last month you can see a couple of very, very high volume bars on the FXI, and really going back to March, right? The FXI peaked in February, but you look at the volume, right? Look at this above average volume. So many weeks here we've had money coming out of the FXI, and I just drew this blue line here where we finished this week, and if we look to the left, you can see this is an area that we've been trading in for years, right? So somebody that's a long-term buy and hold type investor in something like the FXI, they haven't made any money in this thing in years. Of course, that depends on where they bought in, but even if you bought in at the absolute lows back in March of 2020, you're barely up. You're up, but you're barely up on the FXI. If you bought in here or here or here or here or here, you're underwater, okay? So, trading well below its 40-week moving average. So whether it's the FXI, an individual stock, or whatever, guys, learn from these charts. That's why I do this. I'm not beating up on the FXI or whatever, but I do want you to understand that right now, the way I see it, right, the U.S. market is holding up much better than most of the international markets, at least, the EEM and the FXI. And within the U.S. markets, large cap is holding up much better than small or mid cap. So just think about that. Think about the fact that, large cap is outperforming small cap, and, U.S. is outperforming international. And if you feel like you need to make some changes in your portfolio, do so. But of course, those decisions are always up to you. Let me ask you a few questions. Do you manage any of your own money, including in your 401k or your IRA? Have you ever found yourself out of sync with the market, underexposed when the market is rising, or overexposed when the market is declining? If you answered yes to any of these questions, please pay close attention to the balance of this video, because it could be worth a lot of money to you going forward. Do you have a stock market risk management and trend direction system in place? Do you know the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the trend of the stock market? My system is Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecast, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed simple market signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including numerous bull and bear markets. And what I found is that certain conditions exist during various market phases, and then I created simple, easy to understand signals around these different phases of the markets. And the thing is, guys, that most people don't know about or have access to the data necessary to do the research that I had to do to create this model. Simple Market Signals is a proprietary stock market risk management and trend direction model. And Simple Market Signals is perfect for financial professionals and individual investors. There's two major components to the proprietary model. There's a risk level signal and there's the general trend indicator. Let's start off with the risk signals. The risk signals are simply green, yellow, and red. The green signal has the lowest equity risk associated with it. And what you're going to find is that most all upward progress in the stock market will be made in a green signal environment. Said another way, it is hard to make money in equities unless the signal is green. The yellow signal means there's moderate equity risk, and sideways to slightly up or down price action is very common during a yellow signal environment. The red signal has the highest equity risk, and the worst sell-offs, including bear markets, will happen when the signal is red. A quick review of the risk signals. The green signal is the best risk-reward ratio signal for equity investors, and what you're going to find is that most upward progress in the stock market will happen in a green signal environment, as we see here. The red signal is the worst risk-reward ratio signal for equity investors, and what you're going to find is that the worst downturns, including the downturn in Q4 of 18 and the bear market in Q1 of 2020, plus the bear market from 2000 through 03 and the bear market of 07 through 09, all of those are going to take place in a red signal environment. Now let's put it all together and see how Simple Market Signals could have helped you during the fastest bear market in history, which of course happened during Q1 of 2020. We had a strong stock market coming into 2020, so the risk signal was green coming into 2020 and remained green for the majority of January. We did have a yellow signal for about 2 weeks towards the latter part of January, first part of February, and then of course the risk signal went back to green. And then on February 19th, we hit what was at that time the all-time high on the S&P 500. Again, that's February 19th. And then things started to unravel from there. But think about this. Just a few days after the all-time high at that time in the S&P 500, on Monday, February 24th, the risk signal went yellow. And then on Tuesday, the 25th of February, the general trend indicator went negative. And that general trend indicator had been positive since October of 19, okay? So right there, just a few days after the all-time high in the S&P 500, the risk signals started to tell you that something was changing, that there was increasing risk in the stock market. And by Thursday, February 27th, the risk signal was red. And then, of course, the market sold off hard from there. So think about this, guys. I mean, you talk about stress testing my model. During the fastest bear market in history, that started just a few days after the all-time high at that time, the all-time high in the S&P 500, in 1 week, the risk signal went yellow, the trend indicator went negative, and then the risk signal went red, all in the same calendar week, actually within 4 days, right? Monday, Tuesday, and Thursday. So you talk about stress testing my model. Guys, I mean, this is the fastest bear market in history, and look at how Simple Market Signals could have helped you during that time. With Simple Market Signals, you will know what the risk level is and what the trend direction is in the overall U.S. stock market. And the proprietary model is based on S&P 500 data. The S&P 500 index really is the best proxy for the overall U.S. stock market, and it's the only index that has all of the data available that I need to run the model. And guys, it's not about beating the S&P 500. However, that is a possible outcome over time if the tools within the model are employed properly. It's about risk management and risk control. It's about controlling your risk exposure rather than letting the whims of the market dictate your future. The best fit for Simple Market Signals is an investor or a financial professional with at least a 6 to 8 week plus time frame that they're focusing on. If you're a shorter term trader or a day trader, Simple Market Signals may help you a little bit, but the reality is that the best fit between Simple Market Signals and a subscriber is somebody that has at least a 6 to 8 week time frame or more that they're focusing on. These signals are delivered to subscribers in our weekly emailed newsletter. As part of the Simple Market Signals weekly newsletter, you will receive the proprietary risk level signal and charts on the overall U.S. stock market. You will also receive the general trend indicator signal and charts on the overall U.S. stock market. You will also receive a weekly recap of what happened in the U.S. stock market, including performance information and charts. And this is on multiple investments. So we cover small caps, mid caps, large caps. So you'll have a great idea of what's going on in the entire U.S. stock market across all capitalization. You will also receive technical analysis data and charts, so things that are interesting and educational that I think is important for you guys to know will be included in the newsletter on a weekly basis. You will also receive fundamental analysis data points on the S&P 500, so we look at potential earnings per share for the year, as well as the possible PE ratios, and then price levels looking out to the end of this year, and then I generally go out to the end of the next year as well. So you'll have great fundamental analysis data to work with on the S&P 500 right at your fingertips every single week. You will also receive yield curve information and data points. So we look at the 2s and the 10s. So the 2-year Treasury note, the 10-year Treasury note, and then the spread, the differential between the 2s and the 10s. This information, guys, very few people know about it. Very few people watch this. This is so important to really get your head wrapped around because it affects so many areas of the financial markets. And you will also receive the proprietary risk level signals on all 11 major sectors of the S&P 500. So not only do you get the risk level signal on the overall market, but we also give you the risk level signal on all 11 major sectors of the S&P 500. So you can see what the risk level is underneath the hood on all of the individual sectors. And you will also receive sector performance information on all 11 major sectors of the S&P 500 over multiple time frames. So guys, you're going to get all of this, right? And it's going to make you so much more knowledgeable about the financial markets. You're going to be able to have a conversation with virtually anybody about the stock market, and you're going to be able to really understand things at a level that very few people do. And guys, you're going to get all of this for just $19.95 per month. That's less than 67 cents per day. I want to set realistic expectations. The weekly emailed newsletter isn't fancy. It's effective. It's plain text, no color, other than the charts, of course, and no fluff. But it's chock full of extremely valuable information week after week. And please note, due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, this is just due to international compliance regulations. A subscription to Simple Market Signals is just $19.95 per month. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. Sign up is quick and easy. Just go to simplemarketsignals.com. That's https://simplemarketsignals.com. It'll take you about 4 or 5 minutes to subscribe. It's that easy. Once you reach the website, the first thing you will need to do is accept the cookies. Please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. And that is just due to international compliance regulations. All right, so to get started, all you have to do is click this green button, and that will take you to the product page. And this explains, of course, what you get with your subscription. And then just make sure that that says 1, because if there's more than 1 in there, if you have a 2 or a 3, you'll get multiple subscriptions to the service and you only need 1. click the Sign Up Now button, and that will take you to the checkout page. Once you're on the checkout page, fill in the necessary information, anything that is required, including the email address. Keep in mind that this is an email newsletter, so we will have to have your best email address on file, and make sure this box is checked because that's how your email address gets into the system. So if that is unchecked, your email won't get transferred into the Simple Market Signals system and you won't get your newsletters. So please make sure that box is checked. And then, of course, just double check, make sure that your monthly total is going to be $19.95 a month. Remember that your first 2 weeks are free, so your first renewal date will be 2 weeks after your subscription date. Fill in your credit card information. You will need to accept the privacy policy and check that box that says you've read and agreed to the terms and conditions. Click the Sign Up Now button, and it's that easy, guys. It's probably going to take you maybe 4 or 5 minutes total to fill in everything and subscribe to Simple Market Signals. A few points to remember with respect to your subscription to Simple Market Signals. Remember that everything is tied to your email on file. Now, once you subscribe, you will get an immediate emailed confirmation of your subscription. You will also receive an automatic welcome letter, so that's automatically generated from our system. And whether you see that welcome letter or not, I would encourage you to double check your spam, junk, trash, and promotion folders, especially for the first several weeks of subscription, because once in a while, our emails get automatically routed into one of those different folders depending on your email service provider, whether it's Gmail, Yahoo, whatever it may be. And I would get in the habit, I would encourage you to get in the habit of every week or two, just go out real quick and double check these different folders, the spam, junk, trash, and promotion folders, because I can't even tell you how many times I've had people say, well, I didn't get the email, and then when I tell them to go out and check those various folders, oh, there it is. So it's just, the reality of having an emailed service that once in a while, and it's going to vary from email service provider to email service provider, but once in a while, the emails from us, depending on the subject line and other things, will get automatically routed into one of those different folders. Also, I would encourage you to whitelist all emails from Simple Market Signals. In other words, just make sure that your email service knows that you want all Simple Market Signals emails to go to your primary in basket. Also remember that newsletters go out on the weekend, okay? They generally go out Saturday afternoons, but they could go out anytime over the weekend depending on our production schedule, and the next new edition will be sent to you on the weekend following your subscription. So if you subscribe on a Monday, Tuesday, Wednesday, whatever it is, the next new edition is going to come out on that weekend following your subscription. But we will also send you the latest edition, so whatever the most recent edition of our newsletter was, we'll send you that latest edition as soon as we can, but we have to manually send that to you. Generally, you will receive that within 24 to 48 hours of your subscription. So again, if you don't see that first newsletter within 24 to 48 hours, go back and double check your spam, junk, trash, and promotion folders to make sure that it's not hidden in there. Also, within that first 24 to 48 hours, we're going to send you at least 1 or 2 emails with links to training videos that are for subscribers only. So please make sure that you're looking at all of this, because it's extremely important for you to get the most out of your subscription. Please watch those videos that are part of the training material that we send you. Now let's recap what you will get with your Simple Market Signals subscription. With your subscription, you will receive the weekly emailed newsletter, which goes out on the weekends, that will include all of the content that we just talked about. Plus, you will receive midweek update emails when warranted. So if there's a major signal or trend direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to send a midweek update email to get you that information as soon as possible. So again, a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents a day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. To get started, just go to https://simplemarketsignals.com.